Good afternoon or still morning, depending on what time zone you flew in from. Pretty excited to chat about this today. And then Mariano is going to be joining us a little late, but he's on the way. Where a lot of our discussions in this industry tend to focus on, the benefits of stablecoins, the why, the more technical aspects. But distribution tends to be a much tougher part of our space. Where you could maybe argue, and we'll debate it, that some of the incumbent businesses still hold reign there. But I think just to set the backdrop, 11 trillion in terms of on-chain stablecoin settlement over the last 12 months, 316 million digital wallets have interacted with a stablecoin. You're looking at 52 million just in October versus 31 million last October. So tremendous growth and adoption. Now, we'll kind of see where things tend to go post-regulation, but the fact that we have Genius, Mika, and other regimes has really brought our space into the kind of front line of fintech and TradFi. But I have a couple questions. I want to try and make it as spicy as possible, so hopefully you guys debate each other. Before doing so, it would just be helpful for a quick intro. On my side, I cover a lot of our payments and stablecoin investments at the firm. We're a $2.5 billion multi-strat, solely focused on the space, and excited to be here today.
Hi, everyone. Working 1, 2. Yes, all right. Mathieu, I'm the co-founder and CEO of Octav. Octav, we're a portfolio intelligence for a digital asset manager. We work with mostly hedge fund and family office to help them with reporting, reconciling, or anything related to tracking their assets. So,
hi. There we go. Hi, I'm Katina. I work for Stables. Stables.money, because there's about 1 trillion stables companies now out there. And we first started off as a retail-focused company, debit cards for people to spend their stable coins, but now we've launched our institutional arm. And we do stablecoin settlements, OTC, third-party collection and payouts, named IBANs. We're basically a sweet spot between an EMI and a crypto exchange. And we're in about 150 countries. So yeah, that's us.
Hey everyone, my name is Benjamin. And I'm the founder of CAP. We're a private credit engine that's fully insured cryptographically.
Great to meet you. So if you zoom out, for most of the stablecoin history in our space, we tended to characterize our sector as a duopoly, right, between USDC and USDT. And I think you're seeing over the last 12 months several challenges to that duopoly, whether presented through something like JPM's stablecoin or the issuer as a service model. The kind of key question I always find myself thinking about is, do we think that the existing network effects created by USDT and USDC will be strong enough to effectively kingmake them to provide this kind of first mover advantage? Or do we see the kind of incumbent distribution networks, those of banks and fintechs, the Stripes, the Robinhoods of the world, strong enough to be able to push their own stablecoin product?
Ben, you want to start on this?
Yeah. Well, at CAP, we've always had the idea that there will be thousands of stablecoins. Every jurisdiction will have their own regulations, which means local companies will have a competitive advantage on making their own stablecoins. The tranche of T-bill-backed stablecoins, like that part of the market, is very commoditized, right? There's no tech mode. And so the only mode you have is distribution. I think the only crypto-native companies that are able to survive the takeover or the adoption by TradFi will be those that can have some sort of moat beyond just making a stable dollar on chain. You're going to need to do something on top of that, and so that's why we're not going to make our own stablecoin. We're a stablecoin protocol. We're going to build on top of everybody else's stablecoins, like JP Morgan's or Citibank's.
Yeah, and personally, I'm probably more a DeFi maxi, let's say that. And for me, USDC and USDT, they're using DeFi, but they have a centralized component. So it's kind of risky for purists. So there's a lot of other, like CAP, they're using this, but also there's Bolt or there's ALUSD. There's other like small stable coin that are a bit more DeFi. The challenge is like the security, KYC, and ML around that, and also liquidity. We're talking about liquidity today. biggest challenge for these small stablecoin and why they did not thrive that much as like USDC or USDT is the liquidity. We work with a hedge fund that have like 25 million to like $1 billion. If they want to move 5 million, there's only USDT and USDC that can work. So how can we bring more liquidity to different stablecoin? And like Ben said, we're going to have a ton of stablecoin. How do we manage this? Martin talk before was awesome for this. How can we bring technology to bring more stablecoin? That's the challenge. Yes, is JP Morgan going to use USDC or other one? Depending on the liquidity they can have. I think that's really the crucial part of stablecoin is how can we bring better liquidity?
And I really want to like double up on that, on the liquidity component, because a lot of people try to own the whole stack. Like I'll be the issuer, I'll build yield on top of it. I'll have a lending market, have a perptex, I'll have a chain. And that creates silos of liquidity. And so now I'm trying to onboard people away from USDC or away from, JPM or a money market fund. And you're not doing yourself any favors because now you have to recreate all the on and off ramping. You have to recreate all the bridging infrastructure. It's a much smarter idea to focus on your part of the vertical rather than try to do everything yourself. And that's why I think Ethereum is the best chain for stablecoins because they are not trying to do the whole stack. I'm not particularly bullish when people just try to, make a monopoly out of everything.
So you're bearish tempo.
I'm not bearish tempo because Stripe is a huge company and I'm sure they'll figure out a great use case for it. But personally, the reason I'm interested in crypto is this potential for a global financial system that's interconnected, where market forces lead to better outcomes for users. I don't like walled gardens in general.
And just one quick follow-up. You kind of mentioned technology as the key part. If I have, hundreds of millions of users already or trillions in assets, is technology really like the thing that I need? Or, I already have the distribution. So why, if I am JPM, should I use Circle's product or Paxos's product or someone else if I feel comfortable creating my own stable?
I'd like to take this one. I think because, looking at what the market cap is now and what the technology can do already, I think always leveraging off the existing distribution channels out there is much more cost efficient for them. And I think it sort of gets them out, gets them to tap into a more of a bigger market as well. So in my opinion, I think that they should, there's kind of like this two-stack approach. I would call it like the internet money approach, which is like where your stable coins are sitting right now, looking at the flows that are coming through there, remittances, global money movement, and letting, JPMs out there sort of just leveraging off that. And then them having the second stack, having regulated sort of banking products or banking tokens that they can issue. So that's my opinion. I think that's how I would, in an ideal world, would work really well.
I can jump on this, and again, always the more DeFi side of this. But personally, there's also a legal compliance part of this. JP Morgan is a bank; they're going to need KYC, AML, everything. That's why you have a blacklist on USDC and USDT. So they're gonna have to do something specific or work with specific stablecoin that can give them KYC and AML. So that's kind of the challenge for them to go use the DeFi structure that exists at the moment. I think what I'm afraid of is that we could at one point have two kind of DeFi world. The KYC, AML DeFi, and the crypto DeFi, I kind of see. So I think it's going to be different. It's going to be really based on a lot of regulation. Genius Act is one of the first clarity in the regulation, but there's a lot of work to be done. And I always say the same thing. It's been about 14 years in crypto, and I always say the same thing. It's we cannot try to get traditional market regulation into DeFi, because it's a new machine, a new system. We need to build new regulation that fit with the system while we still comply with the old system. So that's the hard part.
Interesting. Maybe related to this, if we look at the stablecoin ecosystem through the lens of a value chain, right? You have the blockchains, the issuers, the orchestrators, the apps at the account level. Obviously, it's a bit of a selfish question as an investor, but where do you think value accrues in that? And I think it's shifted, my opinion, over the last 10 years. But yeah, I would love to open that up.
I think traditionally it was at the issuer side because all you needed to do was have an on-chain dollar that was stable, and that was amazing. And so then you can get mode in that. But now we have everybody and their grandmothers making a T-bill stablecoin as a service project, which are all great, and they have their kind of competitive modes. but that's a race to zero, right? And so you're increasingly having to share yield, maybe not with the users, but the people that are creating the distribution. So an example of that is T-bill stablecoins that give all the yield to, howdy sir, that give all the yield to chain foundations, etc. I think it's just moved up the stack. Now yield-bearing stablecoins are making a ton of money, like Katina or Sky. They're making a lot because they're able to give a user something that they don't have in TradFi. You know, it's no longer enough to give you stability or T-bill yield. Now you need to do something more interesting, and I think the people are able to do that are going to make the most.
Yeah, I think it's the orchestrators, like at that level. I think I agree with you. Like it was the issuers for a long time. I mean, and it still is. They're still extremely profitable right now, but that value is becoming, I mean, what they're doing is becoming more of a utility than anything else. And at the orchestration layer, especially, you're pushing flows through the centralized exchanges, decentralized exchanges, OTC desks, etc. But then you've also got your KYC layer, and, operational layer that, where you can sort of provide value. And then obviously at the tech layer, you've got APIs, dashboards, thinking UX, and there's a lot of, you're putting all of that together and you've got this beautiful polished product for someone to use with them not seeing all the stuff going on in the background. But I think, over time, that's really where the value is going to grow. Yeah.
Curious to hear Mariano on this.
Oh, yeah.
Hi, sorry, the delay. Traffic is crazy here. Sorry.
We're just talking about where we see value accruing in the stablecoin stack. I don't want to put you in this hot seat already, but if you want to maybe throw out your view.
No, yeah, it's a super interesting question, and this is something that we also we think about every day at Sky, right? And for us, it's like super clear that you have two types of kind of wars in the environment, right? You have the distribution war and the yield war, right? The distribution war is super expensive to fight, super ultra expensive. I mean, you can see that on Circle's balance sheet, the amount of money that is paying to Coinbase in order to be the main place for the distribution, right? On the other hand, you have Tether as the king of distribution, right? Being used as the number one asset for perps, arguably the product with most product market fit in the whole scene. And the idea for the rest of the stablecoins is that at some point, you have to think of stablecoins as some sort of liquid fund that needs to provide yield in order to attract users, right? And this is also a pretty difficult game to play because you have, as a company or as a DAO, as an entity, right? You have to create a yield to pass to your users to get adoption, but at the same time, you have to keep a spread, right? And that is a race to zero, basically. And that is why then you have other stablecoins like issuing their own tokens in order to quote unquote bribe, right? Users to start providing hard money for the stablecoin to work on this yield. So yes, it's super intricate the inner workings, but we tend to see the environment in that manner, right? It's like the distribution and the yield, and most of the stablecoins that provide yield needs to behave as a liquid fund.
But I think that's still pretty nascent because even though we know that that's like the next thing, like moving away from just T-bills into stablecoins, like generate more yield, most yield-bearing stablecoins give a yield that's around 4% anyways. And I have to ask myself, like, you're putting money in these liquid funds where teams have full decision-making power or DAOs have full decision-making power of your money, and you're getting the T-bill rate. I mean, that's insane. It's effectively an unsecured loan to the team. And if you look at unsecured lending rates for private credit, first lien, the most secured unsecured rates in TradFi that Apollo does, you're getting 9%. But a DeFi hedge fund is giving you 4%. I think there's some problem there.
I agree with you on this. It's like, and we've seen it on October 10, right? Like there was a lot of risk curator that we're not really looking at everything in the risk, let's say that. And so I think like if we talk with a lot of like traditional people that want to come into DeFi, and they quickly tell us like, well, my risk is not worth it. Like the risk is not worth it there, right? T-bills at 4%, you arrive on like any platform lending, you get 4%. Why would I take that risk? The traditional market is way more mature than us, right? So you need to boost that yield. Like Mariano said, there's a lot of like token incentive to do that, but that's not the long-term game. We need to build real sustainable yield for the long term. Otherwise, as soon as you don't have any more token, and we've seen it since forever, people move to the next project. So like you have to build something for real. We need to stop trying to chase the highest yield. We need to start building real product that bring more yield than the T-bills. Otherwise, what are we really building? So.
No, I think those are all fair perspectives. The one that I want to bring out more, which wasn't covered as much, is the application side. So you teased this a bit with kind of circle and distribution and Tether. If I have a phenomenal centralized exchange in a certain region, and these are actually very profitable businesses, why can't I just keep pressing everyone in the value chain to give me more and more of their economics? Like, would love someone to play the steel man to that. Why would Tether be able to maintain more of its economics over time, for example? I think there's a good argument. I have one, but curious to hear how those not on the application side would push back to the kind of inversion of the fat protocol thesis, which for all those who are early in the space was a big thing, back in, 2016. And it's been challenged a lot lately because I think some of the best businesses in our space are user facing versus protocols. But how would you kind of argue against that?
Well, CAP is set up as a smart contract protocol. The team doesn't make decisions over the functioning of the protocol. We have rules, just like Ethereum has rules. And open market participants can come in and interact with those rules. Obviously, you can have a fat protocol. Look at Walmart. They do very well pushing down their verticals and forcing people to give them tighter spreads. So that can work. But also look at Ethereum, right? If you build a platform where other people can have an economic incentive to give a better return or a better outcome for users, then that becomes your distribution, right? If there are a lot of different companies that can be built on top of you, they will distribute your product for you. And so there's like, both can definitely work.
And to me, it's a question also like it's are we staying in the true value of crypto, of DeFi and everything, or like we want to go more fintech? And I don't think there's the right answer to this. I think we need to adjust and move toward to like have more mainstream, but there's still a lot of development to make sure that happen. And a lot of like new product will bring some value on the app level. Like Aave yesterday launched their Aave app and they cover up to 1 million. Like how the hell did they do that, right? So I think they will catch up a little bit of revenue from at the app size, but then the distribution will always also generate more, a lot of revenue. And I think everyone in the stack will be able to find the right thing if you provide the services. At the end of the day, if you provide the services wherever you are in the stack, you should be rewarded for this. Rewarded the right actor in crypto has been really challenging since forever. But I think that the more the market mature, the better we're going to have real actor at every level of the stack that can get rewarded for PMF.
No, I think those are interesting arguments. I also think you see certain stablecoin businesses get distribution and brand value of their own, right? Like USDT is really popular down here, for example. The next question I have, which is again a little bit of a one that originates from my neck of the woods. In venture, we have this saying that first-time founders focus a lot on product and tech, and second time they really focus on distribution. Maybe for either those in the audience or watching later that are founders, how would you recommend approaching this distribution war, in your words, or this distribution problem? It could be quite a difficult challenge for first-time founders.
Well, I mean, I'm not a first-time founder, so I obviously like.
So you focus on distribution, yeah.
Well, the market has changed. It used to be that if you wanted to get deposits as a stablecoin, so we generate yield on stablecoins, you would have to tweet, do Frog Nation, do crazy things, and get people to deposit into your protocol. Now we have institutions, and institutions are like, for the most part, logical actors. And so if you can, give them a good argument for why they should be using your protocol and why they would, make money from using those protocols, then you have network effects of institutions using you. And maybe you're talking to 100 people to get the same size as protocols that would need to have gotten, 20,000 people depositing for the same amounts. Like right now at CAP, most of our TVL is not incentivized. Is us going to a family office and pitching CAP, us going to a liquid fund and pitching CAP, and them using it on the merits of the protocol as opposed to incentives. And so I think, because when you think about distribution, is often in the sense of retail, of trying to get in exchanges. You think, okay, to be a good stablecoin, you have to be collateral for perps in exchanges. You have to be on Aave, you have to be on Spark, and that's how you get big. But now with institutions, there's just so many different ways to do that. And it doesn't necessarily have to look like a retail product.
Personally, I'm also not a first founder, and the client that we work with, hedge fund and family office, they are way more sophisticated, and they're able to look at the product, and they want to have like kind of insurance of the risk of the protocol and everything, which is more first founder mindset of perfect product. So it's kind of strange because we went from like pure nerds product focus, where it was like Twitter only and just word of mouth, to super distribution. Like, okay, let's give token, let's be everywhere and everything. And now the market is more mature. Therefore, institutional are going back to, okay, you have the distribution, but what about the product? Is it really safe? How does it work? Like the Lindy effect work, but there's also like, okay, audit and who are you? What did you build before and all this? And this is getting really important for them because they will forfeit a 12% yield for 8% if it's way more safe and you can put more size because they're sophisticated and understand the risk. At Octav, like we've been around for about 4 years, and when we started, data was not that important. Now, especially since October 10, every asset manager come to us is like, I need to understand the underlying, what's under everything. All the composability of DeFi is awesome, but you need to understand everything under it. And institutional really understand the power of the data and understand the risk of that. So we see a lot more people wanting to see the product, but distribution is important. So it's...
It also depends when you ask. If you were to say that at the beginning of the year, people say you're wrong. Let's just yield. Maybe after like what happened with the whole stream finance stuff, like there's like I don't know, maybe crypto just has its waves of people caring and not caring about where the yield comes from.
Any comment from the distribution war side?
Yeah, I have quite a few, but being as a product person, I focus mostly first on the utility, right? I mean, what is the utility of your stablecoin in that sense, right? And if you start thinking, kind of decomposing the whole thing, going into first principle thinking, it's, okay, what is the utility of a stablecoin? It's possibly the closest to $1 with a significant size, right? Again, that quote war, it's based on liquidity, right? So that liquidity, in which market are you providing that liquidity, right? I mean, for example, one of the strangest cases for me, for example, is the PayPal stablecoin. I mean, they have such a large user base, but it seems like 80% of the user base of PayPal, they don't care about a stablecoin. They care about the balance that they have in their application, right? And that is crazy because PayPal has a long time application on space, right? On the fintech space. So thinking about that, it's okay. If I'm issuing a stablecoin, what is the utility? It's not perps, for sure. What is? It's remittances. Okay, but if it's remittances, do you have like small shop and offices in every border of every country that it's where the remittances are most transacted, right? Not. So it's difficult then, right? I mean, you have to think about the utility of your stablecoin. For me, that is the first thing. The second is, again, is how much liquidity do you have if you want to provide a solution to a business that is kind of outside of the ecosystem. For example, in Sky, we have something called stars, like sub-DAOs, in which they specialize in different businesses, right? And we have a team that they do, let's put it like TradFi things, right? And they associated with Securitize and BlackRock to finance CLOs, right? Collateral loans obligations. And they are so mean, business to business, this is a super popular product in which you can make a lot of money if you have capital, right? But for Securitize and BlackRock, they don't care if it's USDS, USDC, Tether, whatever. They want dollars, right? So in that sense, we are not saying, hey, yeah, we are giving you USDS to finance CLOs. No, we are giving you dollars. It happens then when we finish the business, the money that we are making, we are paying that to the Sky Savings rate. So people that are saving in USDS, indirectly, they are being also participating on these financing CLOs, right? So it's interesting how you need to first think about utility, then liquidity, right? And then comes the distribution out of that.
I agree with that. I guess from a BD perspective, that's exactly it. Like, what problem am I trying to solve? And then from there, I think that getting really sort of niche, you can't be too big sky, like at this point in the market, right? And then, think about the liquidity, exactly that. That's and the distribution comes. I think the other thing is leveraging. I mean, there's so much out there already, so leveraging what is out there. And, going back to what you said, I think going back to also just how do we get it, whether that's like marketing or, Twitter, getting the name out there. I think, each use case is different, but yeah, I think thinking first, what is the utility? What's the purpose? Get like really drill down to the niche, and then everything else will flow after that.
Very, very interesting. You brought up liquidity. All of you did in a different way. And in 2024, I spent most of my year with local businesses, traveling with cross-border companies, both traditional and stablecoin powered. And you kind of come to this fascinating realization that we all, love speaking about stablecoins in the on-chain context, but when you start employing it for B2B cross-border, liquidity is currently a big issue, right? Like in many markets, you kind of mentioned this a bit, a 5 to 10 million transfer will eat up the whole book, and then you have to start to go to third parties, which then you move back to the old world because they'll charge you opaque fees. There's counterparty risk. Sometimes they'll just take your money. Why does this liquidity problem exist today if we're all here truly believing in stablecoins? What's the missing link?
I mean, crypto is a drop of water in the ocean, right? Like, sometimes it's good to get out a little bit of the crypto sphere and us and all people and realize like we're really small. 150 billion for a human is a lot, but 150 billion in DeFi for traditional market is nothing, right? So I think the reason why there's not that many liquidity is fragmentation of liquidity. Like, we had a lot of experiment and everyone is like trying to do a lot of stuff like USDC and USDT, but USDS now fragment the USDC liquidity, which is good because it's a different technology, right? I'm not saying it's bad, but I think there's a lot of work to be done on the technology. And Martin, before we're speaking, how can we get a better AMM and stuff like that? There's a lot of technology that need to be built before we can really expand the liquidity. I think we're trying to go really fast because it's useful and we see that it's frictionless and it removes some border, but there's still a lot of technology that need to be tested and developed so that we can have deeper liquidity. That's my personal thought on this.
I think that, like you said, zoom out, crypto is just a drop in the ocean. There's huge friction between regulators and the banks, right? And this is, I'm Australian, and in Australia, you can't do anything that's related to digital assets. Like, you will be blocked. Stables benefits from that because we act as bank, we provide banking rails, but, for the everyday user, when there's a lack of regulation, when banks are scared, that is going to prevent flows. It's going to prevent transactions, and that means it's stopping the growth of liquidity out there. So I think that's something to really consider as well. And maybe with Mika, with Genesis, with everything that's with everything that's happening, yes, it will self-correct, but I think we still have a little ways to go as well, unfortunately.
And because you talk about bank, and at least for me, the goal was to replace bank, not to go in bed with the bank. So that's a long topic. I think we don't have the time to talk about this, but
that's our goal too. We'd love our goal. Like, our motto is unbank yourself, but it's still gonna take time. They're way too entrenched. There's such a big institution, and that's probably a challenge and maybe another topic for a panel at the next Stable Summit. So yeah,
I would say that it depends on what kind of liquidity you're talking about, because inter-entity liquidity is actually quite good in crypto, because you have all these redeemable reserves like Sky or like Cap, where you can mint and redeem with different assets. And so, long gone are the days of trying to maintain, pegs of synthetic assets. We all had fun with those many years back. But now really the question is, at some point people need to leave, right? If you're connecting to the productive economy, at some point people need to pay taxes. They need to pay their people that then, I don't know, they pay their electricity bill or they go grocery shopping. And at that point, now they need to leave. And that's really the friction. Because if they didn't have to leave, then the liquidity problem is already solved. It's super easy to send and receive ERC20 tokens on a blockchain. That's not particularly complicated. The complicated part is not being connected to the productive economy.
There's a good analogy I once got from a founder, which is, it's very similar to the early days of Skype. So Skype is VoIP, but when it started, it just enabled one leg. Like you're on VoIP and you can call a landline of someone else. So like you don't actually get the VoIP benefits, but they would subsidize it. But over time, the other person's like, oh, Skype's so cool, let me get an account. And then you have a closed loop system where now you really get the benefits we speak about: 24/7 access, low cost, speed, and programmability, obviously, and voice over internet. Now we're talking about money over internet. But I think that the movement from open to closed loop, in the sense of closed loop on chain, is what gets us there. We just need, I think, a lot of regulatory progress. One other quick question that I just want to throw in is, we always talk about US denominated stablecoins, right? And there's an interesting discussion of, do we need non-US denominated, especially when there's RTP in some of these countries? Would that maybe solve the liquidity issue? Curious first if anyone is in favor of non-USD stablecoins being really big. You please start. And then if not, we can go through everyone.
Well, I have an interesting take, because like usually people say, okay, euros or whatever, like because there are other people that, pay their electricity bills in different assets, right? And they want to save in those. For us at Cap, what's really interesting is, we're marrying these two types of assets. Those that are dollar denominated, high opportunity cost, high market premiums, with those that have low opportunity cost, which initially is like Bitcoin or ETH. But then there's this whole world of fiat currencies with no opportunity cost, or very low opportunity costs, like Japanese yen, Singapore dollar, Hong Kong dollar, that are equally valuable, but again, very low risk-free rates. And so we're doing a lot of work with those, and we need them to be on chain so that they can interact with our system. So JPYC just launched maybe 2 weeks ago. Still very small, but I'm a huge proponent of that, because I think that's the future of Cap, being able to marry all these different kinds of assets.
Yeah, this is
Okay.
Just talk, it starts.
hello. This is a super interesting topic for me, because I founded a company in 2021, which I sold in like 7 months ago. We were doing emerging market stablecoins for Argentina, Brazil, Colombia, Peru, and Mexico. And yeah, I mean, we love them. We love them because we saw the problem that they were solving. Initially, we have created those because when you have exchanges with branches in many different countries with different exchange rates, the settlement that they have to do between their different branches, if you do that with dollar stable coins or dollar per se, you have different exchange rates in different countries. And according to the time that they are also receiving the money, if you are doing wire transfer, or even if you are selling the stable coins, do you have an FX risk there, right? So for them, it's much easier to have all that settlement in their local currency doing stable coins than doing that in the traditional way. That is the first case. The second case that we have been seeing is also related to retail and how they are using crypto cards, right? The crypto cards, for example, here in Argentina, we have a gazillion crypto cards since forever, right? And the bad thing about it is that you have to top up with stable coins in dollar. So it means that you receive your salary, you have to purchase the stable coins, you pay for something with your card, and you have to pay again to convert from dollar stable coins to local exchange. So there's a bunch of fees that you are paying. That is why, for example, there are super big exchanges here in Argentina just writing that thing, So initially for the retail and for the people, it's much easier to top up your crypto card with the local stablecoin, right? Because it's 1-to-1. That's amazing. That's the second thing. And the third one, and it was the most popular for us in terms of the TVL, we get to be number 3 in base past year. It's to offer carry trade on chain, right? For example, our stablecoins were backed, it's more like a hybrid thing with sovereign bonds and dollar stablecoins and forwards, right? And we were paying, for example, for Argentina, we have been paying for 2 years around 48% in dollars APY. It was to my knowledge, we were the high-pay stablecoin out there for 2 years, right? And all that thing was because we were able to create this basket of rolling window sovereign bonds in which you can pay block by block the interest rate, and the people can exchange block by block that rate for USDC again. So it was a super popular product, right? And same for Brazil, same for Mexico with CETES and different things. This is something that I'm still kind of shocked. There's no big player doing it like in a big manner, because it's such a powerful thing and super hyper profitable, you know? So yeah, I mean, I'm a huge proponent on non-USD stablecoins.
Look, I think they're going to be part of the toolkit, but I don't think that they're the entire solution. I completely agree with you, though. Like, completely agree with like how it plugs into local payment rails, the one-to-one, the slashing the FX fees. But at the same time, I think that the backbone of global liquidity is still going to be USD stablecoin denominated.
I don't think it should be. Personally, it's going to be a bit contradictory or like challenging. But personally, like fiat money, USD, as the inflation of the US. You live in Europe. Why will your money inflate based on the US dollar? Because US dollar is inflating with the GDP of the US, with the decision of the US. And now you have USDC and your money, like it's inflating as the US, which is not your country. It doesn't make sense. And to me, it's even more than that. We should not only have USDC and Euro and Yen and everything. We should probably have stable dollar of crypto, like that is not pegged to the US dollar, to the Euro. It should be like Reflexor was doing that. It was a floating stable coin. It's not stable, it's floating, but it was a representation of real crypto mindset. So we clearly need to make sure that it's not only USD, because otherwise the entire planet is going to run on USD, but only the USD will decide inflation. That doesn't make sense. Crypto, like back in the time, Bitcoin is a store of value. Now you have stablecoin, you have the inflation from the US, which is not even your country. It doesn't make sense to me at all. So we need to have all the currency in stable, and we probably need to build new stablecoin or floating coin or stuff like that to use.
There's a pretty cool case in emerging markets where when you have like super ultra high inflation that we had here in the past, with one of the exchanges here, what we did is like a campaign in which they can lock USD stablecoins. It was at that time UCS and USDC, and you can get a loan on our stablecoins in peso, right? So you can top up with your crypto card with that. So if it actually it's like a credit card, you know, paying just the interest rate on USD. But the cool thing is that when you spend that thing with the Argentinian stablecoin, the debt that you have, right, since inflated away like super, super quick with this, just with the stable value of the dollar in Argentina, you can get rid of the 40% of that debt in a year. It was crazy. It was super popular.
That's very interesting. I remember the Reflexor experiment as well. Inventing new monetary systems is very difficult, but at least it was
easy.
Goal.
Everyone will do it. Crypto for challenge. That's.
I think we're coming up on time, but really appreciate all your insights. It's been great, very deep perspectives, and I'm glad we got a little bit of a debate going at least. But yeah, round of applause for the panelists.